Hello everyone, welcome back to my channel. So this video marks the beginning of week number 14 in this road to 200k challenge. And like last week, I've already input the trades for this week, as I was unable to do a live session this time around. And I must say that this week started up on a quite positive note. Markets were strongly up even before the session began. The session itself began during the pre-open negotiation session. Stocks were already up, and once the market opened, stocks skyrocketed a little bit. And as things stand at the moment, a couple hours later, some stocks had they pulled back a little bit relative to their initial gains in the session, and that is why some of the trades that I've already input are a little bit in the red, but it's not really an issue at this point. What matters is that at the end, at maturity, at the end of the week, it's whether the options are assigned or not. So basically, and to begin with, picking up on what we spoke about the last week on Saturday's video, the wrap up of week 13, I indeed sold some calls on Pfizer here, but because the stock started the day rising more than 2%, if I believe, the stock was already trading at around 28.70 when the markets opened. There was it made basically no sense at all to try to sell the option, the call option, with the same strike that we bought it. Remember, I bought these shares at 28.50, as it says right here. So there was no sense to sell calls which were in the money, and so I ended up selling the call with the next strike up, which is the 29 strike call, which is right here. And so we got a pretty good premium out of it, even though of course we are in the red in this trade, which is normal because the stock continued to rise. Now it's 28.85, so the call further appreciated, gained even more value, so that's why we are in the red. But this is not really important, because what matters is at the end whether the shares are sold or not. Now, compared to moving on to the other trades, and given the buying power that we had available, of course, once again, the priority is try to get rid of the current stocks that we have. And starting here with American Airlines. American Airlines, there was a point in the session that was rising almost 5%, and it was getting quite close to the strike of the call options that we sold, which is 14. And basically, because we have already had this call from last week, there's nothing we can do about this, so we just let it be. And I decided to sell 4 puts on American Airlines with a $13 strike price. And so basically the reasoning was this was the put options that give have a good balance between probability of being expire worthless, all right, which was around 80%, and the profitability, the return that they would provide in terms of the premium, it was also very good. And so based on this, I determined that by selling 4 puts, the average price of the entire holding, if these puts were assigned, I would end up with 1,300 shares. And the average price of acquisition of these 1,300 shares would be $13.50. And so this would allow me, if these calls are not exercised, are not assigned, the next ones, if these are assigned, I would be able to sell the calls at with a strike of 13.50 and still breaking even on the entire holding. And so yeah, that is why I sold precisely 4 puts, which will of course allow me the opportunity to have to buy 400 more shares. The next one that I did was Lyft, and again here the reasoning was the same. Given that the current acquisition price was 14.50 of these 400 shares, I made some calculations. I decided also the $13 put is the one that I wanted to sell, and so I decided to sell 10 contracts. And why? Because if these puts are assigned, I would acquire these 1,000 shares, and the overall average price of the 1,500 shares that I would have would be exactly $13.50. So once again, it would allow me to, if these calls expire worthless, I would be able to sell the calls at 13.50 euros next time and be able to break even. So far we are still a bit away from the strike of 14.5, so we'll have to wait and see what happens. For the folks that are also interested in more complex strategies, I have a video coming up in the next few days about advanced strategies, option strategies. And so basically what you have right here with Lyft, all right, and with American Airlines, and also with this LOD right here, these are basically short strangles, all right. So but you will see what this is about in the next video that I will post in the next few days about this more complex strategy, all right. And so given that these trades that I did with the remaining buying power left, I decided also to sell some puts, 4 more puts on EST-LOD again, with just the use of the remaining buying power that I had. I could afford to sell 4 contracts with an 82 strike price, and so this time is in the red. I'm losing on these puts. And why? Because when these puts were sold, EST-LOD was trading at around 90. Now the price came down, but still at this point they are nowhere near being assigned, and so we will have to wait and see what happens. If these puts are assigned, the average price of the entire holdings, which would be 1,200 stocks, it would be around, if I'm not mistaken, around $94-95 dollars, and so this would allow me to, if this call is not assigned, this would allow me to sell the next call options at a much lower price and still breaking even. So the reasoning is basically the same as for the other stocks that I used, that I sold puts on, with the exception of course of Pfizer right here. And so this is the situation. We will have to see what happens at the end of the week. One quick side note on Ford Motor Company. As you can see right here, Ford Motor Company is due to release its results, its earnings today at the end of the trading session. So it will be at around it will be already in the early hours of the next day here in Europe, and so 9 o'clock in the evening on the east coast of the United States. And that is why I did not make any trades on Ford, because I believe that it's better that to let the earnings come, basically have the investors react to it in terms of pushing the price down or up, and then we will have to see if it's worthwhile to make any trade or not, depending on the situation. Because for example, if the price comes up, then for sure I will be able to. I will try to sell some calls at the strike price of 13.50 to see if I can sell this entire holding of 400 shares. If the stock comes down and I ended up freeing some buying power by buying back some puts that in the meantime came down to close to zero, then of course I will sell some puts also on Ford Motor Company to see if I can bring down further the average price. And so for the time being, this is it. Let's just input our trades in our scoreboard. All right, and so let's start first and foremost for the calls, and basically the calls on Pfizer right here. So today is October 28th, so here it is. These options will expire on November the 1st, and so this is Pfizer. This is a covered call, strike price 29. These are 4 contracts. All right, now keep in mind that this is not the collateral that I used. This is the actual collateral. All right, so basically we have to come here and put to this, and now we are going to lock this up in case we're going to need this formula for other occasions at next week, in case these shares are not sold. And so I will continue to sell calls on it. And so this is it. So I basically sold these calls at with a premium of 44, and the fees were 141. So if it was 80, it was 221. So this is basically 220 in commissions. So 0.44 and 2.20 in commissions. All right, so now the next one will be, and yes, let's start by here the American Airlines puts here with a strike price of 13, right? So it's exactly the same timeline here, American Airlines, and this is a cash covered put, strike price of 13, 4 contracts, and this was sold at 7 cents with fees of 2.18. So 7 cents, 2.18. Now next up, let's do the same for the next one, which is Estée Lauder. Some cash covered puts, also 4 contracts. Well, wait, this is 4 contracts. The strike price here is 82, and these ones were sold at 119, and we had a credit of 36 cents. So 119, and here 36 cents. All right, and now all that is left for us is our puts on Lyft, our 10 puts. These were sold at a price of 13, a premium of 13, and we had how many in commissions? So this is 198, so 198, 268, 269, 469, 549, 551. Let's confirm if this is the correct. I said 551, so we'll see. So apparently, all right, so this is 40 cents plus 158 plus 71 plus 282 and 551. That is correct. I always recommend or suggest that when these situations come around, you try to do the calculations in your own head, because this is how you keep your brain always sharp. And this is always something that is very important, especially as you get older. And so yeah, this is the cash covered put, strike price 13, and these were 10 contracts. All right, so this is it. We are facing at a quite good profit if we manage to all of these options ended up expiring worthless. But we'll have to see what happens at the end of the week. For the time being, this is all. This was a quite simple. These were quite simple decisions in terms of the trades that we needed to input, and also this video ended up being quite short, and which also benefits for the viewership from the side of all my followers. And so yeah, for the time, this is it. Feel free to leave your comments and suggestions below, and yeah, feel free also to like the video and subscribe. I'm also available on LinkedIn if you need to send me a message or need to discuss this further. In the next few days, I will be posting a video on advanced option strategies. I will probably not be able to cover all of them in a single video, because they are quite a lot of them, and it also takes some explaining to make it really clear for everyone. But yeah, in the next few days I will be posting that video for you guys to have a look. And of course, if you have any questions, we can also discuss that further if you need to. And yeah, I'll see you all in the next one.